My name is Xavier Gomez. I'm the co-founder and chief operating officer of Invio. Invio is a specialist in managing your data with ease. We put its technology at the service of the business needs of your company. Invio develops solutions for the exploration, control, and visualization of data. We put technology at the service of your business needs. I'm very happy to share with you some insights regarding fintech trend prediction for this year and the coming years. As you know, fintech is a portmanteau of financial services and technology. As I certainly earned that stereotype, those applications are mobile first, customer-centric, and disruptive to risk-averse industries. All hallmarks of modern fintech, but the industry's reach is much broader, extending to the back offices and financial ledgers of the banks, insurers, property management firms, government regulators, and more. Globally, financial technology is projected to reach a market value of $305 billion by 2025, according to market data forecast. That growth is fueled by rapid consumer adoption and by businesses, particularly small and medium-sized enterprise, turning to fintech for banking and payment, financial management, financing, and insurance. Fintech started when Michael Bloomberg started Bloomberg. Before that, there were financial services companies, but Bloomberg was a financial technology company, and it totally changed the game. Fintech companies are the people bringing technology to financial services. They are showing ways to utilize technology to bring finance to a whole new level. I'm an expert and global speaker in data and entrepreneurial finance, and in particular in fintech, as a former banker. I worked during more than 20 years for Credit Suisse at different top management positions between investment banking and private banking, between London, Paris, Zurich, and Geneva. So I know a little bit what does it mean, the financial transformation we live today. Fintech startups thrived after the 2008 and 2009 stock market crash, when banks were under an increased level of regulatory scrutiny that startups were not subject to. But established institutions are catching on and catching up. Right now, the majority of spending of what we call fintech activity is actually in big banks. Fintech going forward will be defined by data and access. This is the raison d'être of Invio, the data analytics. Machine learning will deliver more specific insights from ever bigger data sets, while ubiquitous mobility allows for instant access to the consumer, and for consumers, instant access to their own data. And with the millennial and Generation Z increasingly at the helm of startup, concern over environmental, social, and governance policy are increasingly part of the fintech equation. One of the most interesting trend in the fintech, it's clearly now the cloud adoption in banking services. About a decade ago, banks started adopting cloud technology. At first, they were very careful, and it will included lengthy discussion with conservative regulators and anxious security officers. Later, banks took significant steps to leverage cloud technology. However, does the cloud deliver on its promise of lower infrastructure costs, better integration capabilities, and improved time to market? That's the question tag, clearly. The financial sector expected to spend 500 billion globally on technology by 2021, and a significant portion of that will be funneled into cloud adoption, as reported by Bloomberg, mainly through the support of cloud providers such as Amazon Web Services, Azure from Microsoft, and Alibaba Cloud. But reflecting on the last decade, many of the advisors and decision makers in banking talk about are not necessarily satisfied with the current result. They see a slightly lower cost base, mainly as they outsource hosting of their existing application from the server in their basement to a cloud provider. That said, the cloud promise is kept in the category of more generic application, such as collaboration tools like Microsoft Teams and Google Meet, which saw an unprecedented rise in usage up to 30 times during the COVID-19 crisis. This scaling would not have been possible without cloud technology. But the main difference in this case is that the new adopted technology was built for the cloud instead of moving the existing technology to the cloud. Yet for the mission-critical technology like core banking that facilitate every transaction and financial product for a bank, cloud migration efforts hardly lead to improved functionality, faster upgrading processes, or better integration capabilities. An important reason for this problem is that the technical foundation of this antiquated system are from the pre-internet era. This is the IT legacy system from banks. It's a big problem. Back then, changing product or expanding services was a multi-year process, which is not surprising considering that 43% of the banking system are built on COBOL, a computer programming language that appeared in 1959. Today, the new financial services are introduced faster than ever before. Fintechs and big techs benefit from an absence of legacy system, which allow them to invest in the latest technology and customer experience rather than just keep existing system taking over, and acknowledged in the 2020 report on decreasing banking profitability by EY, Ernst & Young. In terms of time to market, perhaps weeks or months are available to follow and compete against the new players when they put new proposition or services in the market, but certainly not years. Here, we see a crucial difference between organizations that use cloud native technology and the banks that are bound to the legacy system. Within the legacy system, all changes are heavily dependent on each other. The effort to move existing technology to the cloud does not change how they were created. Heavily intertwined applications that can only be changed or upgraded when every relevant other system in the landscape is aligned. When these dependencies are not aligned well, change fails miserably, leading to failed projects or even worse, data leaks or blackout. And while required change grows rapidly every year, the ability to execute does not step up now that the legacy technology is hosted in the cloud. The approach this hurdle, adoption of cloud native technology is effective. It is shaped inherently different as every cloud native application is made up from different microservices, and this independent component interact with other microservices through APIs. This can be an API inside the bank's technology landscape or an external API to consume external services. Each microservices can be upgraded or changed by small autonomous development teams without any alignment. Not being dependent of other teams accelerate time to market significantly, served by continuous integration and continuous deployment, which is central to cloud native technology. Through continuous integration and continuous deployment, teams can update their code up to multiple times per day, supported by automated testing. This can and arguably should be carried out during business hours, as the proof is eating the pudding. If testing does not turn out to be successful, it is a simple matter of rolling back changes. This is a crucial departure from Big Bang update that often only happened once or twice a year, where entire IT departments work multiple weekends and CIOs have sleepless nights. Looking back at the first decade of cloud adoption, banks are not to blame for missing out of the full cloud promise. Simply put, applications such as cloud native core banking were not available. And in this decade, banks learned that updating legacy technology still equals less flexibility and vulnerability. In the long run, whether it is adjusted for the cloud or not. Moreover, the future does not predict any simpler requirement in the technology agenda of banks, as they are constantly pushed by a new consumer expectation and increasingly regulatory requirements. What gets simpler is the way to beat this challenge. Modern banking technology with modern functionality is becoming available in the form of cloud native system. Therefore, investing in the system from previous decade seems rightly a dying trend. Banks frankly need to become a flexible, scalable, accessible as Amazon, Netflix, or Uber, since consumers are increasingly open to alternatives for their financial well-being, and for banks to incorporate tools for regulation and risk requirements. Now that the first movers of banking-specific technology are here to cater in a cloud-native fashion too, it is a blessing for banks that they spend their time and effort wisely. Now, we have to move to a tactical movement on embedded finance. The fintech industry has had a wide couple of years. Consumer fintech startups have been massively successful and managed to attract million customers. At the same time, enterprise companies have created the infrastructure that will make finance truly digital, from payment to API-driven integration and risk assessment. Today, in this keynote, I want to talk about what's the next for the fintech industry. Will tech companies all become fintech companies at some point with embedded financial products? Will new tech giants thrive by powering those embedded financial products? Embedded finance offers a new, very large addressable market opportunity worth than $7 trillion in 10 years' time, twice the combined value of the world top 30 banks today. By abstracting banking and insurance functionality into technology, embedded finance enables any brand or merchant to rapidly and low-cost integrate innovative financial services into new proposition and customer experiences. Fintech supported by VC, venture capitalists, are currently taking the lead in creative, sophisticated embedded finance, offering via banking as a service platforms. Incumbent bank and insurance company now need to make bolder and more strategic move to stake their claim. There are three key issues incumbent will need to address to grasp this new market opportunity effectively and use it as a catalyst for wider business model transformation. Embedded finance is about abstracting banking and insurance functionality into technology, enabling any brand or merchant to integrate innovative financial services into their offering, customer experience, rapidly and at low cost. It is one of 4 new digital business model archetypes that are particularly relevant to financial institutions. First, embedded finance. 2, intelligent solution. 3, marketplace. 4, ecosystem orchestration. Put simply, embedded finance is about enabling any business to manage and sell innovative financial services, seamlessly integrating creative form of payment, debit, credit, insurance, or even investment into their end user experiences. The simplest example of this action is paying for Uber ride. You don't get out your credit card at the end of the journey. Uber product designers have enabled payment to be embedded in your experience of getting a lift and for the driver into their experience of getting paid the right amount at the right time. This is a clear game changing. Payment facilitation. Companies like Stripe, Square have grown rapidly over the last 10 years by enabling by sort of capability for digital company. They are now worth 30 billion and 57 billion US dollar respectively, and are expanding their capabilities in other areas. Complexity increase as you move from payment to debit, credit, insurance, and investment. But if you are a merchant or brand in any sector, you want to make your proposition to customer as attractive as possible. Today, customers have to interact with their bank to get a debit and credit card, loans for a sofa, car, or house. And there are a lot of back and forth between the customer, the bank, and the merchant, with a few options personalized to the needs of individual customers. Klarna has grown into a 5.5 billion company, US dollar, by enabling brands to offer innovative credit solution at the point of purchase, for example, by paying in installment. If we take the example embedded finance to embedded insurance is now fast emerging too, enabling your car share service, for example, to come automatically with mobility insurance, or your new camera to come with a theft and damage protection right out the box or as a part of the overall price. Some of this happen already today, but it's clunky. British Airways offer travel insurance on this website when buying a flight. Okay, at the moment, it's a little bit challenging, but when we come back to the business after COVID-19, we will see this kind of example. But it's not a quick and cost-effective for brands and merchants to integrate this offer, and they tend to generate and manage by the insurers rather than configured in the real time by the brand. For banks and insurance, who today white label their product and capabilities to third parties, the time frames are months or years to conclude deals and years to implement at scale and see a return. Now, fintech clearly is a buzzword since many years now. But now I want to show you, to discuss with you, what is the potential of the fintech use case and impact on one particular sector. How fintech can help the healthcare industry. For example, it's a typical use case I like this. Fintech has been a major factor on the financial market for a while now. It is becoming quite hard to ignore its presence and wide-sweeping effects. It does not just exist in a vacuum, so there is a very real link between fintech and certain other sectors. One of the most notable examples is healthcare, where we have seen the rapid adoption of various fintech solutions that have resulted in an overall better situation for everyone across the board. It's hard to predict how things will play out in the future exactly. But one thing is certain at this point: the link between fintech and healthcare is impossible to ignore now. The first point is fintech is accelerating payment process in healthcare. Payment has commonly been a roadblock in healthcare and a point in the whole process with a lot of potential for things to go wrong. And while things have been improving in this regard little by little, fintech has arguably caused the biggest change in this area. Completing payment in healthcare is now easier than ever, and fintech has done a lot to accelerate the process and make it more streamlined for both parties. Patients no longer have to navigate complex systems to make simple payments, and the same goes for the institution and healthcare workers that charge those payments in the first place. Second, fintech is making everything more accessible. And this brings us to our next point. The accessibility of everything is becoming significantly better thanks to fintech and its advance into healthcare. Even procedures that require more complex payment schemes and operations are now easily accessible, and there are many reasons to believe that things will continue to improve in this regard in the future. It is interesting to think about the possibilities that this might bring to the table, because it can open the doors to many procedures that were beyond the reach of certain patients in the past. Third point, working with patient data is easier than ever. Doctors and other healthcare workers now also have an easier time when it comes to working with patient data and maintaining complex data sets involving a mix between private and other information. There were already systems in place to facilitate that in the past, but they were far from perfect, especially when used by workers without adequate training and experience in their use. Now the situation is more different, and there are many reasons to believe that it will continue to move in that direction for the foreseeable future. What patients can expect is a better, stricter attitude to their privacy, and with that, the possibility to more comfortably discuss procedures and paths that might not be immediately comfortable for many people. It's also easier for patients themselves to keep track of where their money is going when it comes to healthcare and how the whole process is moving along. All in all, the changes that are on the table right now and going to significantly alter the situation in the near future and beyond it too. The fourth point, it is more adequate personalized care. Personalized care options have been a popular topic for some time now. But it seems like the advance of fintech was what really brought them into the center of the spotlight and made them a viable topic for discussion. There are many ways to develop more personalized treatment paths for different patients, but there used to be significant technological barrier to that is a near past with the rise of fintech and its tight integration into the healthcare sector. It seems like it's easier than ever to deliver exactly what patients want and in the way they want it. Of course, we'll still have a lot of progress to make in this regard, but we are quickly getting there. The fifth point, how to prepare the future. It's hard to prepare for what the future might hold with regard to healthcare and fintech. But the link between the two is quite obvious, as is point, and anyone interested in either of the two fields or even more actively investing effort, resource in them, has a duty to learn about what the current developments are and what is coming down to the road soon. Many of these predictions may not play out, but it's a good idea to pay attention to them when they come up on the radar. Because even those that don't work out will still give you some valuable pointers about the futures. In the end, healthcare is one of the most critical sectors in our world right now. It's a good thing that is seeing such great results together with a field like fintech, because the potential for a good synergy between the two is undeniable. Hopefully, that's not going to change anytime soon, and things will keep moving in the same direction. I want to talk with you now about how fintech segments that are gaining investor interest despite the COVID-19 crisis. cross-border payments, digital brokerage and trading, insurtech, and peer-to-peer lending are thriving in the midst of the COVID-19 and the recession experienced by most countries worldwide. According to projection by Adroit Market Research, the global fintech market will be worth at 460 billion of US dollar by 2025. These figures represent an 12% compounded annual growth rate over the 2018 to 2025 forecast period. Amid the positive outlook, three fintech subsectors are drawing the attention of investors. They are expected to grow faster than other segments and sustain growth in the years ahead. The first sector is cross-border payments. While many countries are closing their borders or minimizing their interaction with neighbors, global trade remains unstoppable. Commercial activity are declining across the board, but the acceleration of e-commerce growth, including international transactions, is a welcome development. According to different payment platform as a services, payment platform as a services provided reported an 85% growth in the transaction volume back in May, offering a clear example of how cross-border e-commerce opportunities have flourished even as the COVID-19 revised economies. With this encouraging report, payment platform as a services providers attracted additional investment. It closed more or less billion of financing round led by different VCs. Cross-border payment companies such as PayPal are expected to come out of the COVID-19 pandemic in a stronger position. Macquarie analyst from Macquarie Bank, Macquarie analyst Dan Dolev thinks that the long-term growth potential for PayPal will return once the pandemic problem is resolved. For e-commerce coronavirus, it's going to be less of a shock. Over the long term, PayPal emerges as a winner as the people use it more often, Dolev said. The second point is the second sector, sorry, this is a digital brokerage and trading. Rising the volatility in the capital market has not stopped investors from investing. Instead of retreating to safe havens, many have become adventurous and opened the idea of looking for profit opportunity in stock market and other tradable assets. According to CB Insights research, trading activity has surged amid the pandemic. This enthusiasm for trading can be attributed to the rise of new platforms that enable trading with minimal risk or better risk management method. Platforms such as Free Trade, Robinhood, or eToro, or even Coinbase offer easy-to-learn way to retail investors to seek out profit in the volatile market. For example, Robinhood recently closed a 200 million Series G funding round. Free Trade reported raised around 9.2 million US dollar for its 2020 crowdfunding campaign. Investors are attracted to the innovation introduced by company and their embraced digitalization and internet-based transaction. Brand's Gold Holdings, three-way arbitraging for example, offer an ultra short-term investment opportunity that piques the interest of retail investors. Its arbitrage is an investment strategy that guarantees a positive payoff in some contingency with no possibility or a negative payoff and not net investment. This kind of uncommon but sound digital trading system excites investors who are looking for alternative opportunities. This is the reason why we can see numerous IPO for this sector. A few weeks ago, we see the IPO of Coinbase for crypto asset, and we will see other IPO, in particular Robinhood and eToro in coming months for 2021. The third subsector is clearly InsurTech. A PwC research suggests that insurance industry is preparing for disruption to catch up with fintech innovation. There is a good reason to believe that insurance is indeed heading down the path of disrupting innovation, whether it is the effect of external factor or the ability to improve operation using artificial intelligence. The research underline. Insurance companies have remained viable despite going through various scandal controversies and outright failures in time of economic turmoil. Investors still consider this industry profitable through venture capitalist VC are willing to support disruptive developments in the industry that lead to innovative products and services. InsurTech is a big business, and its size and reach are expanding, according to Accenture study. It is said to be the next big thing for the insurance industry. CB Insight Research has a similar projection, describing InsurTech as a truly global trend. What drives this growth is the emergence of startups that invest in advanced technology such as big data, AI, intelligence, artificial intelligence, and IoT. Fintech is an emerging industry that is shaping up to become a major driving force for finance. It is proving itself to be a vital factor for economies to survive a pandemic. With the businesses embracing digital transformation and shifting their operation online, fintech is set to defy the economic downturn as it attracts more investment and help businesses and individuals survive the health and economic disasters. To conclude, I would like to give you an insight about a big trends we see in fintech industry. This is clearly the rise of the super app in fintech, and the rise of this super application in fintech is clearly the future to face bank. I strongly believe the next wave of fintech companies will pioneer distribution avenues and take a page from the past in ways that are both cost-effective and inherently trustworthy. In some cases, offline is a new online. Fintech are leveraging existing communities and affinity groups to acquire new customers. It will be possible with the advent of super app. As more of the services we use to lead our lives more move over to our smartphone, we anticipate more of the so-called super apps. Super apps of course, for super application. Like we have seen in Asia, in particular, we have a live use case from China with the two leaders of super apps, WeChat and Alipay. We have other examples around the world outside fintech. Yandex.Go, the Russian startup, could be Europe's first super application combining all key aspects on demand, transportation, and delivery. The new platform will replace the Yandex taxi app and add-on Yandex car sharing service, Yandex Drive. It also integrates schedules and routes of above-ground transport that were previously available in the Yandex. Yandex.Go will enable people to solve any task that involves moving around the city quickly and on a time. You have also another example with Rappi, a Colombian startup, is one of the most prominent candidates for the super apps platform in Latin America. Today, Rappi is one of Latin America's most valuable startup worth about $4 billion US dollar, according to people familiar with its financial. Thirdly, it started offering just food delivery. Now, Rappi provides many services such as e-scooter, payment, peer-to-peer transfer, movie tickets, and many more. We have another example with Line, a Japanese startup, is a chat app turned social media platform launched and dominant in Japan. While debuting as a chat app, it has become a full-fledged social media platform as well as an integrated service provider. Last example from fintech space is Paytm. Paytm, the Indian startup. Paytm digital payment giant has launched Paytm mini programs to showcase its product and services to its user base. If you notice, it is similar to the WeChat mini apps programs. For Paytm user, it will be a seamless experience that does not require any separate download and enables them to use their preferred payment options. Businesses such as restaurant, cafe, fashion, retail, cinema, groceries, travel, and lifestyle can leverage their users to develop a new sale. Partner of the program can send push notification through the Paytm app to run campaign and engage users. Users are also allowed to share the Paytm mini program offering with their friends. Clearly, consumers search for simplicity and typically favor one app that has an intuitive and easy to use interface that allow them to do everything they need in one place. We expect that these super apps will have an accelerated growth in 2021 and further, following the pandemic, as a user seek to streamline their digital services and use trusted, simplified apps. We therefore expect an emerging of shopping, payment, and financial services in one wallet application. The advantage here is that the consumer can choose which elements are the most important to them based on their individual needs. It can therefore provide the user with an attractive proposition, and then now they can access all key services in one place. My name is Xavier Gomez. I'm co-founder and chief operating officer of Invio, and it was a real pleasure to share some insight about fintech trend prediction to Open Banking Week. Thank you very much.